Hi, this is Mr. Gideon. So now that we've talked about what aggregate demand is, I want to talk about how aggregate demand changes. And just like in the beginning of talking about the changes in demand and supply in individual markets, I want to caution you here because there's a difference when you say there was a change in quantity demanded of real GDP and a change in aggregate demand overall. A change in quantity demanded of real GDP is brought about by a change in prices, and it's shown by moving from one point to another along an existing curve. So if prices change, we slide from one point to another along an existing AD curve. But what we want to talk about here is what would cause an aggregate demand curve to shift to the right and have to be redrawn and relabeled as AD sub 2, which of course shows an increase in AD, or a leftward shift, a decrease in aggregate demand. What are those kinds of factors that would cause that kind of change? This is really important because as we go back and think about an entire economy and look at the big picture, there are some theorists out there that believe if wages and prices are flexible, that the economy can fix itself. And one of those ways that it can happen is that aggregate demand shifts. If we happen to be in a recessionary gap like here on the left, and we can anticipate that aggregate demand is going to shift to the right because some factor, or maybe more than one factor, is changing, then that's good news for that economy. We can move out of a recession to long-run equilibrium where we have all this good stuff that I listed when I showed you how to graph a picture of the entire economy. We move towards natural rate of unemployment. We move towards full employment, towards a natural rate of income, towards Q sub n, natural output, all that good stuff. And if we happen to be in an inflationary gap where prices are too high, and the hope is that you get back to natural levels of all the things that we want for our economy, and to get back to long-run equilibrium, the AD could shift to the left as one of those ways for us to get there. So it's important, and we want to talk about what are the factors that could shift AD left and right. So if we're talking about spending on US goods, we're talking about, of course, the C plus the I plus the G plus the NX, as we would using the expenditures approach for any country. We're talking about US residents, US companies, US governments, and foreigners. And we're talking about, essentially, once we visualize that, being able to predict which way AD is going to shift, right or left, if any one of these components increases or decreases. And that's summarized by this graph, or this visual here. So let's say that consumption decreases. The households across the United States buy less of US stuff. Then AD is going to shift to the left. If they buy more, it's going to shift to the right. Now you might have a question that asks you in that form for the most part. What would happen to aggregate demand if consumption decreased? You would say aggregate demand decreases. That's one of the components. It's a piece of aggregate demand. But you might not get the question quite that easily. It might talk about a component of consumption. It might talk about one of these factors. So they're all interconnected and they're a part of consumption. Let's talk about these. What if wealth decreased across the entire country? Well, wealth is related to what you can consume, so if wealth decreases, AD is going to shift left. If wealth increases, AD is going to shift right. What about expectations about future prices and income? If people expect, consumers now, because we're talking about the C, if consumers expect that their incomes are going to decrease in the future, then they will most likely buy less today in preparation for the future. So AD is going to shift to the left. If they expect in the future that income is going to increase for them, they'll buy more today. Same thing about prices. If they expect prices to go up in the future, they'll probably stock up today, so AD would shift to the right. If they expect prices to decline in the future, then they'll probably hold back for now, waiting for those prices to come down, and so AD would shift to the left. Interest rates. Let's say that interest rates, both in the money market and in the global funds market, decrease. Are people going to consume more or less? they're going to consume more. Because now, if interest rates are coming down, they can afford to take more loans in order to buy stuff. If interest rates increase, of course, then consumption is going to decrease, and AD shifts to the left. What about income taxes? If people's income taxes are cut, in theory, they have more money to spend, and so households will buy more, consumption increases, AD shifts to the right. If income taxes are increased, then consumption, which is a piece of AD, will decrease, AD shifts to the left. Now let's focus in on firms and companies, the I in C plus I plus G plus NX. So a lot of the same things apply. If interest rates go up for loans that businesses would take, then they are going to invest less, and so AD shifts left. If interest rates decline, then more businesses can afford to take more loans in order to buy products and services. AD is going to shift to the right. Same thing as consumers with regards to expectations about the future, particularly when it comes to sales. If companies think that in the future sales are going to increase, then chances are they're going to invest more today, and that would shift AD to the right. If they feel that future sales are going to decline, at least that's just their expectation, then they'll hold back today, be more conservative, not buy as much land, not buy as much equipment and other physical capital. AD is going to shift to the left. Business taxes. Business taxes are cut, then in theory, ceteris paribus, I is going to increase, AD is going to shift to the right. If business taxes increase, then of course these companies have less resources to invest. And remember, the big I, investment, doesn't mean the way that you might associate it with. We're not talking about putting money in the stock market, that kind of investment. We're talking about putting money into resources to expand your company. And so if business taxes increase, they're going to have to cut back on that, and AD shifts to the left. The G is very simple. We'll come back to this a little bit later, but essentially if government increases their expenditures, AD shifts to the right. If government decreases their expenditures, AD shifts to the left. And then net exports. Two factors here. Of course, we could start off by saying, what happens to AD if net exports increases? Well, of course, AD is going to increase, and it's going to be drawn to the right of its original position. If net exports decrease, AD is going to be drawn to the left, because we have a decrease in AD. But once again, you could be given one of these subcomponents. What if I said foreign real national income increases? So the income, real income, so factoring out inflation, forget about prices, truly real income increases in other countries that are buying our stuff. What's going to happen to AD for our stuff? Well, they can afford to buy more of it, so AD is going to shift to the right. If foreign real national income decreases, as their incomes decrease, they can afford to buy less of our stuff and all the other stuff that they buy, so our AD is going to shift to the left. Finally, exchange rates. If the exchange rate changes to the point where other countries can buy more of our stuff based on the value of our currencies, or more specifically, the value of their currency, the strength of their currency goes up, it appreciates compared to ours, then they can afford to buy more of our stuff, and AD is going to shift to the right. If other countries kind of lose in the exchange rate process, if the value of their currencies decreases or depreciates compared to our currency, that basically makes it harder for them to buy our stuff and our services, and so AD shifts to the left. Now all of this is ceteris paribus, right? If you zoom in on any one of these factors and hold everything else constant, what we're saying is, a change in one variable will lead to another, but that's where the imperfection of social sciences come in, because you know intuitively that reality is different, that there's all kinds of things changing and happening, and there's all kinds of interplay in reality, and so that's the shortcoming of theory. Chances are you very, very infrequently have one of these factors changing while all the other ones are constant. If you just look at exchange rates, the exchange rates are fluctuating every day. So that's something that is if there's any constant there, there's the constant of fluctuation. But we oversimplify once again to try to explain how variables can have an impact on each other. There's a little more information here that has to do with factors that can shift the aggregate demand curve. So also commit these to memory, but we're going to go into depth a little bit more on these as we progress throughout the semester, particularly fiscal policy and monetary policy. And when we talk about the process, we really delve into the details of the process of monetary and fiscal policy. You'll understand a little bit more of why, if the central bank, for instance, increases the quantity of money, aggregate demand would increase. But for now, I just want you to commit those to memory and have those as something that you can refer to as we get more into depth in future units about fiscal and monetary policy.